Okay, welcome everyone. We're just letting everybody in. Apologies. I think we're only 2 minutes late this time. Not too bad. All right, so we're just going to give everybody a few minutes to come in. Thank you so much for attending today. And over to you, Greg.
Well, thanks, Christine, and hello, everyone, and welcome back to many of you. Just a reminder, Greg Pollock here, President and CEO of Advocis and moderator of today's session. So this session is the second of 2 webinars on insured buy-sells, which review the contents of a new publication, The Essential Canadian Guide to Insured Buy-Sells, that delves into a number of technical and non-technical topics relating to insurance-funded buy-sell agreements. Today, our co-presenters will discuss in some detail the tax rules that govern corporate buy-sell arrangements funded by life insurance, the main types of buy-sell structures, and their related tax consequences, and special considerations for family-owned businesses. So returning from last week's webinar is the author of the guide, Kevin Wark, who is KLU's tax advisor and also managing partner of Integrated Estate Solutions. Our other presenter, Glenn Stevens, is the Vice President of Planning with PPI Services. So before we begin, just a reminder that today's session will qualify for 2 CE credits. Please ensure that you have logged into Zoom with your real name and the same email address as your registration to ensure Advocis can validate your participation. And if you're using a different email address today, please notify us so that we can match up your records in order to ensure CE credits, CE certificates. The plan is to go for approximately 2 hours with a 5-minute break in the middle. There will also be time at the end for questions. You can use the Q&A button at the bottom of your Zoom screen to ask your questions, and feel free to direct it to one or both speakers. So I'll now turn it over to Glenn to kick things off. Glenn, over to you.
Thank you, Greg. Good morning, good afternoon, everyone, depending upon where you are. It's great to be back here again with my friend Kevin. We're going to go through, first of all, just a recap of last week, a very quick recap of the things that we discussed last week, which were some of the common options for funding a buy-sell agreement on death, the benefits, obvious to most of us, I think, of having life insurance funding for the buy-sell, some design features around the different types of life insurance coverage, structuring insurance ownership and beneficiary designations, a very important part of the planning. We're going to be addressing that again. It's kind of a recurring theme. And common life insurance clauses and shareholders agreements. Those are the main things we covered last week. Now this week, we're going to look at the different types of buy-sell arrangements and their related tax consequences. It's going to be by necessity, I think, more technical than last week, although we'll try to take it easy on you. Certainly the guide itself has a lot of technical aspects and examples in there that those of you want to delve deeply into the tax issues can do that with the guide if we don't go quite far enough today, but I think we'll challenge you with some of the material today as well. We're going to give a very quick overview of partnership buy-sell arrangements. Again, that's covered in greater depth in the guide itself. And then finally, some special considerations for family-owned businesses. And as you can all appreciate, the considerations are much different for family-owned business than they are for arm's length businesses, and we'll get into some of those issues in the latter part of today's webinar. And just like last week, there will be 2 polls to test your knowledge, and hopefully all the questions will be understandable, unlike last week. Just kidding. Okay, so what types of life insured buy-sell arrangements are we going to address today? First of all, we're going to take what we'll call a building block approach. We'll try to start from the simpler examples and build our way into the more complicated ones, just as a way of highlighting the different structures that are available. Unlike the old days, I'll say the old days going back a few decades, there's not one way or one or two ways to structure a buy-sell. There are many ways to do it and many different factors that go into the decision about what types to use. So we'll be highlighting those different structures. We're going to change the fact patterns a little bit from what we normally use. We're going to, a lot of the examples we use to illustrate points are maybe a little bit overly simplistic just because we want to show different results as easily as we can, but those aren't always realistic examples. So for example, in these examples, we will assume that the deceased has a capital gains exemption available. We'll assume that the corporate owned policy has an ACB, which in turn will reduce the CDA credit. A lot of examples that we use historically have shown zero ACB in the life insurance policy, which gives us a nice easy CDA calculation, but it's not always realistic. And we will assume a shortfall in insurance funding, which again is more of a realistic scenario than the assumption that we have every dollar of insurance that we're going to need to buy out the deceased. Each example has more complexity, but can provide better tax results depending upon the estate planning objectives that you might have. The goal is to provide you with an appreciation of the elements of a well-drafted agreement with life insurance funding, and to give you an idea of some of the complexity of the planning that goes into that. There may be other ways to optimize the structure and the tax results depending on client situations. Again, what we're trying to say is that there's no one size fits all way of doing this, right, Kevin? The guide goes into a lot of technical detail showing the different options that are available.
Yeah, we just can't recognize in all the fact situations and changes to tax laws that may result between the implementation and the ultimate outcome of the buy-sell agreement. So flexibility is key.
Yeah, that's right. And that is the theme of this, I think, ultimately is we need to be flexible in how these agreements are designed. So the clients are John and Kim. These are our case study victims. In particular, Kim, who's not going to survive this fact pattern. John and Kim own a company called Joki. Its fair market value today is $2 million, and they are 50-50 shareholders. They are not related to one another. They are arm's length. John is 38, Kim is 63. They are Canadian residents and citizens. They deal with each other at arm's length, as I said. Joki is a CCPC, a Canadian-controlled private corporation that carries on an active business. The ACB and paid-up capital of their shares is nominal, and again, we always assume that, but I think that's a realistic assumption most of the time, Kevin. In many cases, these companies are built from scratch, and the ACB and the paid-up capital of the shares is very often, or most often, nominal. John and Kim want to enter into a buy-sell agreement that requires the purchase of deceased shareholder shares at fair market value. So that's the overall objective.
Yeah, and I guess one point here that's often assumed or overlooked is the citizenship, residency and citizenship, but more citizenship of the people you're dealing with. And that's an essential question to ask and get answered and maybe even verify, because if you have Canadian resident US citizens, the tax results we're talking about here today will not apply and may in fact create adverse tax results.
That's right. And we mentioned that briefly last week, and it bears repeating. I think whenever you're doing fact finding with a client, you need to, one of the questions that really should be asked is that when you're inevitably likely going to be dealing with Canadian residents, but you may be dealing with someone who's a US citizen or whose spouse or who has family that are US citizens and are subject to US tax laws as a result. So for sure, that's a question that needs to be addressed. And if you do encounter that, as Kevin says, what we're discussing today will not apply to them. Those same tax planning opportunities aren't there, and those individuals need cross-border tax advice. It's as simple as that. They will need to get advice from someone expert in that area. So some of the options that we'll be looking at with John and Kim are personal crisscross buy-sell with personally owned insurance. That's always a starting point. It's not my favorite way of structuring a buy-sell, but it's a good place to start the conversation. We will then talk about corporate crisscross buy-sell, where you have a purchase by the survivor, but it's using corporate owned rather than personally owned insurance. We'll talk about different structures of share redemption, the 100% and 50% solutions. We'll talk about those briefly. We'll talk about the spousal roll and redeem, which is a big deal these days and a very good way to implement a tax deferred transaction in the right circumstances. And then we'll talk about a combination or hybrid agreement with corporate owned insurance where you build in the maximum amount of flexibility, and Kevin will address that in greater detail later. So 5 years later, we started off with Kim and John having $1 million each of value in their company. And they funded that with $1 million of insurance on each life. But since then, the value of the business has grown to 2.6 million, or 1.3 each. There's no more insurance in place. Kim has passed away, triggering the buy-sell agreement. At the time of her death, she had 500,000 of capital gains exemption remaining out of a total right now of in excess of 900 lifetime that each person gets. She has 500,000 at the time of her death remaining. The shares of the company do qualify for the purposes of the exemption. We're going to assume some tax rates here. We're going to assume a taxable capital gains tax rate of 27%. Which equates to a 54% marginal rate. And we're going to assume a 47% tax rate on non-eligible dividends. So our assumptions or our examples will assume those tax rates. And that, of course, will vary by province and by person. So personal insurance is best used when, arguably, the shareholders want to keep it simple. I'm not sure that's always the simplest way to do it, but I think it's the easiest maybe for people to understand. It's also better where there are few shareholders, like two. In our example, it's certainly worth talking about when you only have two. And the insurance premium for their respective coverages is fairly comparable. We don't really have that here because of the difference in age. It's helpful when the shareholders are paying tax at a similar rate as the corporation. More often than not, the shareholders are paying tax at a higher rate than the corporation, which does affect the decision. And it's also helpful when the shareholders have access to the capital gains exemption. It's not necessary to use personal crisscross in those circumstances, but it's certainly helpful when they have access to the exemption. It makes it more of a consideration in favor of personal insurance.
Now, Glenn, I think you've mentioned in the past that you don't see these types of agreements implemented very often.
That is absolutely right, Kevin. I look at a lot of shareholders agreements and have done over the years, and I've seen very, very few of these. We talk about it when we do presentations, and I think it's important to sort of start there. But I think we'll get into some reasons why. We talked a little bit about this last week. You know, not the corporate tax rate is much lower. The after-tax cost of insurance at the corporate level is typically much less. So that's often as far as you need to go in the discussion about whether you're going to have personal or corporate ownership. But I've rarely seen it. It's almost always corporate-owned insurance that's used, and more often than not, that's the right way to go.
The one situation where this may work is we talked about temporary buy-sell agreements last week, and the need to perhaps have something as a stopgap until things are finally implemented properly, and maybe term insurance crisscross basis with a temporary agreement might be one reason to have this kind of
except Kevin, I think even if it's a temporary arrangement, I would prefer to have the insurance owned in the corporation, because we looked at that case last week, Brown and Laurie, where they had personal insurance. They didn't have an agreement, as it turns out, but they had personal insurance payable to the surviving shareholder, and it didn't end well. I think even in a case like that, yes, it's better to have it than not have it, for sure, but I think I'd favor corporate-owned insurance in that case as well, just because it puts people on more of an equal footing. If there's a death benefit paid, they're 50-50 shareholders between the estate and the survivor, and they can work things out if they haven't fully documented things. But you're right. I mean, it's definitely better than not doing anything, having that personal insurance at the beginning.
Okay.
Yeah. So, John, as you can see, I'm not enthusiastic about personally owned insurance as a buy-sell structure. We do see it rarely, and that's the bottom line. But and why did they decide not to proceed with this structure? In our example, John's cost of insurance funding is significantly higher than Kim's. In other words, he's paying for her insurance. She's much older. It's cheaper to fund the insurance inside, quote unquote, cheaper to fund the insurance inside Joki. And again, it's what we've talked about. The after-tax cost of premiums inside a corporation, typically much less than personal. The deceased estate will own insurance on the survivor's life. That's a complexity that we sometimes forget about. If you've got personal insurance, shareholder A dies, well, shareholder A's estate will continue to own a policy on shareholder B. and there could be policy transfer issues there, legal issues around the transfer of that insurance potentially back to the surviving shareholder. So that's a bit of a wrinkle that sometimes enters into it. You need to have a process to monitor that the insurance remains in force. If Kevin and I have a crisscross arrangement, how do I know Kevin's actually paying the premium on the policy on my life? I know Kevin's an honest man. He's probably paying the premium. But we should have a process for monitoring that the insurance remains in force. Much easier to do in a corporate setting. A planning point here, and I think it applies really whether it's corporate or personal, where there's a shortfall in insurance funding, the additional funds need to come from personal after-tax dollars. And we'll address that as we go through this crisscross example. So here's the diagram with corporate insurance. We're assuming crisscross with corporate insurance. We start with Kim and John, 50-50, corporate-owned life insurance, $1 million each. And essentially what's going to happen is on Kim's death, the shares are going to be bought by John for a promissory note, and he's going to pay off the note to the extent that he can with a capital dividend received from the corporation. So that's how we would illustrate that. And we'll just talk about the steps that we would implement here. The first one is, first thing that happens, of course, is the insurance is paid, usually within a very short period of time before anything else happens. The insurance is paid to the corporation. In our example, Jokey's going to receive $1 million tax-free, but there's a policy ACB of $40,000. And again, we're assuming an ACB in these insurance policies because I think it is more realistic to assume that. So the policy ACB is $40,000. That means there's a $960,000 CDA credit. Step 2, Kim's final tax return is filed. Tax is paid on her capital gain, net of the capital gains exemption. So her capital gains exemption was $500,000. Her capital gain was $1.3 million. She's going to pay tax on the difference. John purchases shares from Kim's estate with a promissory note. There's no capital gain to the estate. It obtained the shares at fair market value and is selling them for fair market value. So the gain is in Kim's terminal return. It's not in her estate. Jokey will then declare a dividend to John from the insurance proceeds, electing the maximum, and this would be in the agreement, would be required to declare the maximum available capital dividend from the insurance, which is $960. John uses these funds to repay part of the promissory note. So he's got $1 million. We're assuming he's taking the full $1 million out and paying tax on that little bit of extra dividend. And he will have $300,000 that he still owes the estate. And typically the shareholders agreement will address how to deal with that shortfall and likely paid over a period of 3 to 5 years, likely to pay off that note. In the end, John now owns all the shares of Jokey with an aggregate ACB of 1.3 million. So his original 0 plus $1.3 million from the purchase after Kim's death, and his shares will have a fair market value of 2.6. So here are the tax results. The crisscross arrangement results in Kim paying $216,000 of tax. So that's $1.3 million of capital gain minus $500,000 of capital gains exemption times 27% tax rate. So that's where her tax comes from. John's tax, $19,000. We're assuming that remember we had a $960,000 capital dividend tax-free to John, but there was an additional $40,000 paid to him, which is taxable at 47%. So John is going to pay $19,000. We're assuming he's going to come up with the money independently. John's ACB in both cases is 1.3 million after the purchase. There's no CDA left behind, no CDA at all in the personal crisscross example. And Jokey's value at the end of the day remains at 2.6 million. And of course, John owes Kim's estate 300,000, which we talked about. That will likely be paid off over time. So corporate versus personal crisscross, it's again, using more efficient corporate dollars to fund the insurance premiums. That's usually the way people want to go. Plus, we also talked last week about just the psychological aspect of owning and paying for the insurance at the corporate level. Corporate ownership helps manage any premium cost differential. And we talked about this last week with John and Kim, different insurance costs, quite a disparity in premium. Generally, clients are happier to share that proportionately with their shareholding. So they're indirectly, in our example, sharing those premiums 50-50, which seems to make it easier to swallow for most people. John will retain control of the insurance on his life. So on Kim's death, the policy on John's life will remain in the corporation under his control. He doesn't have to buy it back from Kim's estate in the case of a personal crisscross scenario. Kim, either way, is using her capital gains exemption, and John is getting an increase in his cost base. So the tax results are pretty much the same, but the considerations around the ownership of insurance are different. Some other issues: the policy proceeds could become subject to claims by Jokey's creditors. So if Jokey does have creditors at the time of death, Kim's proceeds are paid into the corporation, potentially exposed to creditors. That is true. Maybe less subject to creditors if it's personally owned. A big issue, John and Kim may decide to sell their shares in Jokey to a third party while they're still alive. If they want the insurance on their lives, there may be some policy transfer problems that arise from that. They have to remove the policies, transfer ownership of the policies from Jokey to themselves. There's some planning you can do around that, but it's an issue that needs to be addressed. Corporate-owned insurance could limit John and Kim's access to the capital gains exemption. So if they're using permanent insurance with cash values, and it's corporate-owned, the cash values are passive assets. They could potentially disqualify or help disqualify the shares as qualified small business corporation shares. But again, there are ways of planning around that. We would want to avoid, there are ways of avoiding that, using holding companies, using certain corporate structures. So we should be able to plan around that particular problem. Okay, so let's talk, we've talked about the survivor being the purchaser. Now let's talk a little bit about the corporation being the purchaser. So the number, for the first example of this is the 100% solution, we'll call it. Again, we're starting in the same place with John and Kim, 50-50 with the corporate-owned policy on each life. And in this case, the agreement says on Kim's death, her shares will be redeemed, in other words, purchased by the corporation using the maximum capital dividend account possible. John, in this case, is not the purchaser, the corporation is. So what are the steps? Again, Jokey, the insurance companies always are first in line. They pay up right away, which is always good. Jokey collects the insurance proceeds and gets the CDA credit, $960 in our example. Kim's final tax return is filed. At that point, there will be tax paid on the capital gain after using the capital gains exemption. So before anything else happens, there's a capital gain in the estate, just like in the first example, and taxes have to be paid initially in the terminal tax return. Step 3, Jokey redeems the estate's shares using insurance proceeds and a promissory note, because remember, there's not enough insurance to cover the full $1.3 million value. Jokey will elect, pursuant to the shareholders agreement, the maximum capital dividend arising from the insurance, that's $960. The remaining dividend will be taxable to the estate, and a capital loss will arise from the disposition of the shares. Now, I do want to mention here that when shares are redeemed in this way, we've got a dividend. We've described a dividend that's partially capital or tax-free and partially taxable. In fact, we've oversimplified the mechanism here. There's a couple of steps that would normally have to be taken to get this result. And it's a bit of a technical discussion that needs to be had with the tax advisors. But at the end of the day, you're going to have 2 dividends. One is a capital dividend, one is a taxable dividend. And there just are some additional steps that need to be taken to get us to that point in step 3. Step 4, the estate files its tax return for its first taxation year, pays tax on the taxable dividend. So remember, there is a portion of the dividend that's taxable above and beyond the capital dividend account credit. It'll claim a capital loss pursuant to the rules in the Income Tax Act, but restricted by the stop loss rules. Those are those rules that came in 1995 that may restrict some of the capital loss carryback, and it carries, but there is nonetheless still a capital loss that goes back into Kim's final return, and that's where the tax refund comes in. So the tax is payable in the estate on the taxable dividend, but there will be a refund in Kim's return for the capital gains tax that was paid in the year of death. Any unused capital losses retained in the estate to offset capital gains in the estate, if there are any in the future. And as a result of all of this, John now owns all the shares in Jokey with an aggregate ACB of 0, because he didn't pay for the additional value that he's obtained. but his value is now 2.3 million, which is a result of his 1.3 originally, and the 1.3 of shares that Kim redeemed, but there's an amount owing, the 300,000 for the shortfall of insurance as a debt of Joki, which reduces its value from 2.6 to 2.3.
Yeah, so that's different than the crisscross methods, because we are able to get the debt in Joki, which means it can be paid out of its after-tax income, and as well we've got a reduction in John's potential capital gain because of Joki having that promissory note outstanding.
Exactly, and the theory, of course, is that $300,000 shortfall would, pursuant to the agreement, be paid off over a period of years. That's the assumption we would make, and hopefully John's a young guy, will live a long time, and that debt will disappear eventually off the books, and Kim's estate will be out of the picture. Now, this is what I call a lawyer's spreadsheet. Kevin and I are both experts in designing spreadsheets, and this is the best one we could come up with. I'm not going to go through this. The whole point is not to go through this, but this is the section of the act that applies when we're doing this sort of share redemption structure, 112 3.2. And you have to, and again, this is for the tax advisor to worry about. This is not for you to worry about, but just be aware there's a very complicated calculation that has to go into effect. Now, this is one of the reasons why the examples we use will often have a simple fact pattern, because as soon as you add in ACB in the insurance policy, or the availability of the capital gains exemption, it gets to be a very, very complex calculation. And that's why we sometimes try to oversimplify our examples. Again, we will spare you the pain of going through this, but that just gives you an idea of what the tax advisors have to face. And of course, and a tax accountant will come up with a numerical spreadsheet that probably works better than this one, Kevin.
Yes, probably. And the guide itself sort of goes through this calculation for each scenario where the stop loss rule applies. Doesn't necessarily make life easier for you, but it's set out in the guide as well.
And then again, looking at our I would say pretty good lawyer spreadsheet here, just adding another line to deal with the 100% share redemption strategy. The estate tax is 160,000. So you can see that compares to Kim in the crisscross version paying 216. In general, depending on the facts, the 100% solution results in the lowest amount of tax payable to the deceased and the estate. And it's 160,000 here. John pays no tax. He hasn't had to take anything out of the company. It's all insurance. And Joki's value, as we've discussed, is 2.3 because of the existence of that debt to Kim's estate pending the final payout.
Yeah, and this chart also doesn't show that there is 190,000 capital loss remaining in the estate, but it may or may not be of value depending on whether the estate can generate capital gains before it's wound up and all the assets are distributed.
Right. Right. Okay, so the contrasting the 100% solution and the 50% solution, we're not going to talk in depth about the 50% solution, but I'll just describe generally what it does. The 50% solution basically limits the amount of capital dividend paid to an estate so that the stop loss rules aren't triggered. As soon as you get beyond a certain amount, the stop loss rules are triggered. Again, the 100% solution where you are electing the maximum CDA tends to be the best result for the estate. And so if we're doing a redemption, typically we're going to end up with the 100% solution being used, because the objective is typically to benefit the estate to the greatest extent possible. The advantage of the 50% solution is that you've got typically capital dividend account credits being left behind in the corporation for the survivor. That allows the survivor to take out dividends on a tax-free basis in the future. The overall tax result for everybody, including the survivor, the deceased, and the estate, tends to be better with the 50% solution, but people will usually gravitate to the 100% solution because it's the quickest way, the best way to get a tax efficient buyout of the deceased. But again, the 50% solution is another thing that can be addressed when the agreement's being designed. And just the impact of a lack of insurance, total insurance funding, or the impact of a policy ACB in existence at death does reduce the impact of the stop loss rules. So the stop loss rules work very well if you don't have ACB in the policy, or if you're fully insured. To the extent that you've got an insurance deficiency or a policy ACB, the impact is lessened somewhat. But again, this is all about planning and flexibility, and these are just general rules that we're discussing here.
Great.
And now I think it's your turn, Kevin.
It is. So big picture here is Glenn's gone through structure showing the results if you do an all purchase by the survivors personally, which could be funded corporately or personally, or a all share redemption. The hybrid arrangement says, well, maybe there's benefits to using both arrangements depending on the circumstances. And in fact, both might be employed in the same situation. So it really leaves the door open for the parties to determine whether it's better to structure as a personal buyout or as a corporate share redemption. And I think we talked about this last week, Glenn, in terms of who actually makes that decision. And
yeah.
And we both have a view that it should be left to the estate to determine how it's ultimately structured, while still trying to maximize the benefits to the surviving shareholders.
Yeah, I think so. I think at least to the extent that insurance is available, we're usually showing the insurance as the most tax efficient way to buy out and cost efficient way to buy out a shareholder. So I think it makes sense to give the executor that decision as to how the buyout is structured. One thing I would encourage people to look out for are agreements that talk about coming up with a strategy that benefits the tax objectives of all parties. Well, you know, the purchasers and sellers have very different perspectives as to what is tax efficient, and it is often difficult to reconcile those two things. So most of the time you're trying to I guess satisfy the needs of the estate and the deceased more so than the survivors, because they may not agree on one structure that works best for both sides.
Right. So here's schematically how it's set up, corporate owned insurance on John and Kim's life. And because Kim has remaining capital gains exemption, it creates the opportunity to allow John to bump the ACB of his shares in the company to the extent there is capital gains exemption, in this case, 500,000. And then, so we want John to be able to purchase shares from Kim's estate, but the remaining shares will be repurchased again using proceeds from the insurance policy. So once again, Kim passes away, insurance of $1 million comes into the company, creates a $960,000 capital dividend account credit. Kim's executors file her final tax return. There's an $800,000 capital gain after claiming a capital gains exemption. And then the next step here is that John purchases some shares from Kim's estate to realize a bump up in the increase the value, the ACB of his shares. And this is funded through the payment of a capital dividend from Jokey up to John. And we're assuming in this case that John doesn't have to give a promissory note because the share classes are different. So the $500,000 can go directly from Jokey up to John, all capital dividend account, and he purchases $500,000 of shares from the estate. And then the remaining shares are redeemed by Jokey. And in this case, there's $500,000 of insurance left. There is a taxable dividend of $340,000. So $800,000 goes up to redeem the shares. $340,000 is taxable, and $460,000 is CDA. And there is a promissory note provided for the remaining amount that's outstanding. So the estate files its tax return for the year. For its first taxation year, it pays tax on the $340,000 of taxable dividend from the share redemption, and then it can claim a capital loss from the redemption of the shares by Joki. And in this case, the stop loss rules apply to reduce the capital loss by a nominal amount. It goes, the 800,000 loss is reduced to 740,000, and therefore 740,000 loss eliminates most of the capital gains in the terminal return of Kim. And the net result is that John owns all the shares in Joki. There is a bump by the amount of shares purchased by the estate, and Joki's value is reduced as a result of the promissory note owing to the estate. So if you compare the hybrid method versus 100% corporate redemption, which Glenn went through, as I noted, this is more advantageous to John because he's able to acquire shares, and that does not have a detrimental effect to Kim or the estate because they're using the capital gains exemption to offset the gain on the shares being purchased.
And Kevin, I'll just interrupt you there. And just a few minutes ago, I said it's hard to find an arrangement that satisfies both parties' tax planning objectives. This is an example where it does, because Kim gets her estate, whatever, gets the capital gains exemption, and John gets a bump in his cost base. So this is one example where both parties would be benefiting.
That's right. There's only a slight tax cost to the estate for the taxable dividend, as we'll see, in relation to the overall tax costs of the 100% corporate share redemption. So here's the comparison here. Because we're able to carry back a capital loss, it eliminates all but $16,000 of tax in the terminal return. The estate pays tax on the $340,000 of taxable dividends. So if you add it together, it's not much more than the 100% solution. But in contrast, John now has $500,000 of ACB that he would not have had under the share redemption, 100% share redemption strategy. So that's why we would want to look at a hybrid scenario in this particular situation.
And again, the tax advisors here have the benefit of hindsight, right? We've built in the flexibility into the agreement, but we're not deciding ahead of time how many shares are sold to the survivor and how many are redeemed. That decision's made immediately after death, which is the advantage of flexibility.
Yeah, good point. Okay, the last, it's not the last structure, but one of the last structures we're going to talk about in detail anyways is a spousal roll and redeem strategy. And this is something you can build into any share redemption strategy, but it can have particularly good results because of the avoidance of the stop, in effect, the avoidance of the stop loss rules. But it depends, you need to make sure you have a backup strategy because a spouse may be there when the buy-sell agreement's implemented, but the spouse could pass away, there could be a divorce, and therefore you need to fall back to a hybrid or 100% redemption, whatever makes sense. And in this case, we call it spousal roll and redeem with a twist because we also get some additional benefits to John because of the capital gains exemption available in the terminal return. So in this scenario, we start with John and Kim, 50-50 owners, but rather than the shares being purchased from Kim's estate, Kim's will provides for the shares to go to her surviving husband, Chan, and the buy-sell arrangement itself through a put call option allows those shares to vest indefeasibly in Chan and therefore roll over and not be subject to tax in Kim's estate. So the big question here is how do you make sure the shares vest indefeasibly, which is the requirement for the spousal rollover to apply, where there's a buy-sell agreement in place that appears to require the sale of those shares to the surviving shareholders. And the CRA has been asked to comment on this, and they've basically indicated if those shares are subject to mandatory buyout on death, they cannot vest indefeasibly, and therefore the rollover would not apply. But in an archived interpretation bulletin, they indicated where the terms of the buy-sell agreement give one or other party the option to acquire the shares to sell or acquire, the shares will vest indefeasibly in the spouse at the time of the transfer, and they subsequently confirmed this in a 2010 technical interpretation. So that's why this is structured on a put-call basis to fall within this exception to the requirement that the shares vest indefeasibly.
And Kevin, this is the roll and redeem totally depends upon the indefeasible vesting, correct? And
Yep.
And this IT bulletin, as you said, is archived, and I guess that means it's not updated. You can't really rely on it. And I believe we had a conversation earlier about the CRA taking a look at this as well in a more recent case.
Yeah, we're aware that the CRA has raised the potential application of GAR to this kind of structure. And I guess their view is that if the sole purpose of structuring it this way is to get the spousal rollover combined with the tax advantages we're going to talk about on the redemption, then they potentially could apply GAR to the structure. And
of course, that is the only reason they do it that way. So
yeah, and it's interesting because they've said in the past that they will permit it, but it appears they, at least in one particular situation, didn't like the result.
And so again, if you're doing planning now, if you're helping someone design an agreement now, you would, in theory, you would have the roll and redeem if that's something that makes sense in the circumstances. You would have, as Kevin has already said, some redemption strategy or hybrid strategy as a backup in case there isn't a surviving spouse. But you might also give the executor, the deceased personal representative, the ability to decide whether or not to go through with the roll and redeem if it turns out 10 years down the road that it's not effective anymore. So again, building in flexibility is critical.
So going through the tax results related to this strategy, again, the insurance proceeds received. In this case, under Kim's will, her shares passed to her husband, Chan. There is a put-call arrangement under the buy-sell agreement that allows Chan to put the shares to either John as survivor or to the corporation for redemption purposes. And therefore, the rollover would apply to these shares. However, because Kim has got access to the capital gains exemption, we are going to elect out of the rollover. This is permitted under another provision of the Act, and it can be done on a property by property basis. And each share can be treated as separate property for purposes of these rules in order to trigger a $500,000 capital gain. So in effect, we have $500,000 worth of shares triggering a gain where the exemption is used, and the remaining $800,000 of shares rolled over to Chan. The estate distributes the remaining all the shares to Chan, and then we do a restructuring at this point in time. And the reason to do this is to isolate the $500,000 ACB that arose from triggering the deemed disposition rules on death into one class of shares. So we restructure so that there is preference shares with a fair market value and an ACB of 500,000, and common shares with a fair market value of 800,000 and nil ACB. Joki will then purchase Chan's common shares for $800,000 and elects that the full amount of that deemed dividend be treated as a capital dividend, so received tax-free by Chan. And because those common shares, because no loss is generated on those shares, they have a nil ACB, they've rolled over, we don't worry about the stop loss rules applying because there was no gain in the estate that we need to worry about, and Chan receives the proceeds on a tax-free basis. Then Chan will put the remaining shares to John, and because they have a 500,000 ACB, there's no gain or loss to Chan. And in this case, Joki will pay the remaining insurance proceeds to John and declare a capital dividend to the maximum amount of the remaining CDA, which is 160,000. John will use the dividend payment and a promissory note to pay for the shares purchased from Chan.
That's a lot of
So
steps, Kevin.
there are a lot of steps.
That's a lot of steps, but it's worth the effort, isn't it? It's worth the effort.
Yeah, it's a building process. And this is designed to maximize everybody's tax results.
Yeah.
So in doing so, neither Kim, the estate, or Chan pay any tax on the $1.3 million of shares. John now owns all the shares of Joki. They have a fair market value of 2.6 million, and he's bumped the ACB of his shares by 500,000 through the arrangement, and there's still a promissory note owing to Chan of $300,000. So if we compare this one to all the other structures, you see we've eliminated all the tax to the estate and to Kim, and there's very nominal tax payable by John as a result of the payment of a capital dividend to him, or dividends to him, and he's benefited from a bump in the ACB of his share. So this is why spousal roll and redeem is kind of a very powerful way to structure, and perhaps one of the reasons the CRA is giving this an eyeball. I think we've made these various points one time or another. The flexibility provided by the spousal roll and redeem in particular needs to make sure the buy-sell is pretty tight, so that the options are being exercised properly and there's no tax gamesmanship going on by the surviving spouse or the estate that puts the surviving shareholders at some form of disadvantage. And as we've indicated, the estate should have the option as to how the arrangement is structured to maximize their tax position. Glenn, any other thoughts before we move on?
No, you've summarized it well, Kevin. I think we have covered those points, and those are all important ones to remember for sure.
Great. So we're going to take it up a notch again and now introduce holding companies into the structure. And we've noted a number of concerns with the use of insurance with an operating company. It's concerns that you can typically live with, but there are advantages to having a holdco inserted into the structure. And this is a refresher of the reasons why you may want to do that. First of all, it can be done for estate planning purposes to get non-active and active family members involved in one way or another, directly or through a trust. It can be used as a way to purify OpCo to ensure the shares continue to be qualifying shares of a small business corporation. You can protect the insurance policy and other corporate assets from OpCo's creditors by having them owned within the holding company. It can facilitate different estate planning objectives for the various shareholders in OpCo. And as we'll see, it can create more flexibility when designing buy-sell structures, and in turn, potentially create some additional tax benefits.
And Kevin, I'll just jump in briefly. The third bullet point, I think, is the one that usually is causing people to consider holding companies, where all of a sudden there are extra assets on the balance sheet of the operating company. They're not needed for the business. They're not being distributed to the shareholders. And if they're going to be invested, they're exposed to creditors. So that's often the motivation for incorporating the holdco. I think more often than not, that's why you see them used. And then all these other advantages get layered on.
Yeah, that's right. So the buy sell guide goes through a number of different scenarios with opco holdco structures, and we're going to look at the share redemption at the opco level, holdco owner, opco beneficiary design. And I think that would typically be the most likely approach to take. Is that your perspective, Glenn?
It is, yeah. I think as we go through, you'll see the advantages of this. And yes, I would say so, Kevin. In this structure, typically that's the one we'd see and recommend the most often.
Great. So here's a schematic of what it looks like. So we still have John and Kim involved in the business, but they have evolved the structure and have done some estate planning. So now they've done estate freezes such that they now have holding companies, JoCo and Kimco. They have introduced a family trust. The two families have trusts. So John has frozen his shares, common shares in OPCO or JOKI, and received back preference shares. And the trusts have received the common shares, the gross common shares in the company. So this just goes through in a bit more detail. The freeze was done at a time where JOKI was worth $2 million. So they each took back preference shares worth $1 million. They've got $1 million of insurance in their holdcos with OPCO as the irrevocable beneficiary, and it's designed for buy-sell funding, with the family trust owning common shares in the holding companies. So again, we assume poor Kim passes away, and we are simplifying the facts here just to make it a bit easier to follow. So we've assumed the policy has no ACB, so there's no CDA grind. We've assumed there is no capital gains exemption that we're trying to maximize or take advantage of. And we're assuming there's no spousal rollover here. So under Kim's will, her son James will be the sole beneficiary. So there will be a deemed realization and a gain on the preference shares owned by Kim. The family trust continues to own the common shares in the holding companies. And as I said, there's no capital gains exemption. So from a insurance structuring point of view, the holding companies own the insurance on their shareholders' life. So JoCo owns the insurance on John's life. Kimco owns the insurance on Kim's life. So that means that they control their own insurance. And on the death of Kim or John, the insurance will flow into JOKI and will be used to repurchase the shares of the holding company. Again, a number of steps. There is the filing of Kim's final return. There'll be $1 million capital gain with respect to the preference shares, no capital gains exemption. JOKI collects the insurance proceeds from the policy owned by Kim's holding company. And because there is no ACB, we get a full CDA credit. JOKI uses the insurance proceeds to redeem Kimco shares and elects that the full $1 million deemed dividend be treated as a tax-free capital dividend. And then from there, we're not going to go into great detail. There's a lot of flexibility in terms of how Kimco can use that insurance. It can be used to redeem the shares owned, the preferred shares owned by Kim, or some other strategy could be used to minimize taxes and maximize value for the family trust. And one key point here is that if Kim is married to Chan, the agreement or her will could provide that the shares go to Chan, not to James, her son, to get to get the rollover and therefore avoid the tax reporting that we've already noted because she's gifting her shares to James. So this would provide a complete deferral for Kim in terms of the preference shares and leave it up to the surviving spouse to figure out how to deal with the tax bill.
Yeah, that's right. And I think a couple of points that are sort of worth reinforcing there. The tax deferral, obviously, if Kim has a surviving spouse, is a big bonus. And unlike the roll and redeem, where you have to have an agreement with put call options and so forth, you don't need that here. The agreement is between holdco, the holdcos, and the opco. Once the shares are redeemed, then it's all about whatever Kim's will said. And if her will said, I leave everything to my surviving spouse, it's a rollover there. And it's a tax deferred purchase at the holdco level that it can work really, really well. And again, I guess reiterate a point from last week. The reason we like holdcos owning the shares or the insurance, there's a number of, I guess, reasons, but one in particular that's important is the whole policy transfer issue. So that if each party has their own policy and their own holdco and they sell shares during lifetime, all we need to do is change the beneficiary designation from opco to holdco, and there's no disposition. And we can govern that change in beneficiary designation can be managed in the shareholders agreement.
Great points. Thanks, Glenn. So just a summary of the cash flow and tax results. Joco, the holding company, now owns all the shares in Joki. No increase in the cost base of its shares, and the fair market value of those shares have grown to $2 million. John continues to own preference shares in his holdco, fair market value of $1 million and a nil ACB. The interesting thing to note here is even though Joki has not grown in value, there is $1 million of value that now attributes to the shares owned by the family trust because of John owning preference shares. The increase in the value of the holding company attributes to the family trust and the beneficiaries of that trust. So that and also as Glenn noted, the insurance policy on John's life continues to be owned by Joco and can be used for estate planning purposes relating to John's death. So as you can see, the introduction of a holding companies to the structure can create some additional advantageous tax planning results. Okay, we're going to very briefly talk about partnership buy-sells. We reviewed this with some advisors in terms of how often they see partnership buy-sells, and we were somewhat surprised to learn that there's not a lot of action in this area, and I guess there's many more incorporated businesses than partnership owned types of businesses, but you may run into these, and the guide provides a full review of how they can be structured. And there's essentially three different ways. One is partner owned insurance with partner buyout, or partnership owned insurance and either a partner or partnership buyout. And it's possible that you could have a corporate partnership, and that introduces some additional planning implications. And I think the thing to note is that partnership owned insurance is somewhat similar to corporate owned insurance in that it's received tax-free by the partnership, and the rules are somewhat similar in terms of it can allocate out the insurance benefit to the partners if you wanted to do a partner buyout on a somewhat similar basis to corporate owned insurance. That is, the insurance death benefit less the ACB of the policy increases the cost base of the partner's interest in the partnership, which allows it to effectively be withdrawn from the partnership on a tax-free basis. So that's an advantage of having insurance versus having to use potentially using other partnership property to fund a buyout. And if the partner is a corporate partner, and the insurance is flowed out to that corporate partner, it also results in a CDA credit. So it can come out both tax-free to the extent the death benefit exceeds the ACB, and similarly, that amount also credits to the corporate capital dividend account of the corporation. So that has implications for type of planning you want to undertake. So we're going to move to a poll, and Christine can get that up for everyone. We're going to give everybody a minute or so to complete their responses before we show you the answers.
Sounds good. It's up and running.
So you'll need to scroll through to see question 3. We already have someone leaping to the forefront.
It's not me.
And I just wanted to take a minute to let everybody know that's great. We have some good questions coming in the Q&A. So I've noted all of those down, and we'll send them to the panelists and hopefully be able to get to quite a few of them today.
Good.
Okay, we're up over 100 now. We're getting there. $136. Boy, this is a good group. Okay, we're getting more responses now than we have registrants. That's not possible. Glenn, are you cheating here?
Somebody's cheating. Somebody's putting in multiple.
Okay, well, I
answers.
think
Not me. I can't even see the questions, so I can hardly cheat.
it looks like the action is just about done.
All right.
So question 1, corporate crisscross method with corporate-owned insurance involves corporation redeeming deceased shares is false. It's ultimately a personal buyout using the corporate insurance proceeds. The second response to the second, we got 87% of the people getting that right. It's true, the hybrid method is preferred where the deceased has unutilized capital gains exemption. Let me scroll down to question 3. If that's possible, there it is. Well, this was nip and tuck, but the answer is false. The spousal roll and redeem strategy requires it to be a discretionary agreement where put calls are put. If it's mandatory, then you cannot get the rollover. So the question may have been confusing, but that's the right answer. So thanks for participating. This brings us to, it's past the midway point, but we wanted to give everyone a 5-minute break to do what they need to do. So we'll reconvene in 5 minutes, and Glenn will take over from there. We'll see you soon.
We're back.
Okay, see if I can get control of the screen. There we go.
All right. Shall we resume? Okay, so what we want to discuss now, we're going to move on to the subject of family business, and that's always its own category. A lot of the same considerations apply, but many things are different, of course, when it comes to family business and how this all works. So we're going to talk about in the next little segment some of the special considerations around family business, the role of wills and powers of attorney, shareholders agreements for family business. I'll be talking about those topics, and then we'll move on to estate freezes and the use of family trusts, and some brief discussion, time permitting, I guess, Kevin, of pipeline planning and changes to section 84.1, all with a view to getting done before 4 o'clock and then time to leave, time to answer questions. So what are the special considerations? A lot of the cases we're dealing with, of course, the parents are the controlling shareholders and perhaps the founders of the business. One or more adult children may also be active in the business, and that's often where the challenge comes in, is where some are active and some aren't. Succession arrangements for family businesses often lack formality, and we can't stress enough the importance of documenting things, especially in a family business, I would say, because family dynamics can really mess things up if you don't have proper agreements. Absence of detailed planning can result in significant family conflict. And of course, we see that with the big business families in the newspaper all the time. And of course, with smaller, less famous people, it happens too. And it's never a good thing. It can be a very tragic way, in fact, for things to evolve in a family. And the parents' wills may be the only legal documentation that specifically governs the distribution of shares. We'll talk about wills in a bit more detail, of course, but that's again, in any kind of a business with any size, just having the will alone it's important, obviously very important, but it's rarely enough by itself to deal with the family business succession in a thorough way. So the key questions to ask: who will receive the shares and the control on the death of the parents? How will non-shareholder children be treated? The age-old question, and insurance can obviously provide a solution in many cases. Will the parents have sufficient funds for their retirement? Does the estate have enough liquidity to cover taxes and other liabilities that arise on death? Those are all major questions that an insurance advisor will ask their clients when they sit down with them. Okay, will considerations. The parents' wills typically govern the transfer of shares in the absence of a shareholders agreement, and I've seen too many examples, as I alluded to earlier, where this is all they've done. They've provided something in a will which may or may not achieve their objectives. They're critical and must be planned carefully, but they're not enough on their own. You really need other planning, and we'll get into that as we go through this section. Who's going to be the executor? A major decision. You can have multiple executors. You can have one executor that deals with, let's say, the shares of the business. Maybe they have special expertise, or there may be a reason why you need a particular person of substance to deal with the shares of the corporation, and maybe other executors with less business know-how are more than capable of dealing with the rest of the estate. That's fine. What's the role of the surviving spouse? We see cases where both spouses are active and able to manage the business. We see many cases where one spouse is active and the other one isn't. And what does that mean? It often suggests the use of a testamentary spousal trust, because you want to leave the benefit of the shares to the surviving spouse, but maybe you want the trustees to be in charge of how the business is run, and the spousal trust is a good way to deal with that, and you still get tax deferral, but a greater level of control over the shares. That's in the will. That's where you would find the spousal trust. Multiple will planning, a big deal in Ontario and BC in particular, where probate fees are high. Probate fees are also high in Nova Scotia, but my understanding is multiple will planning is not possible there, at least hasn't caught on. But in Ontario, for sure, multiple will planning has been around for more than 20 years now, and is a fundamental part of planning for a business owner, an essential part of it, because you're avoiding in Ontario $15,000 of tax for every $1 million of value, and it's similar in BC as well, those numbers.
And Glenn, if I could interject,
Yeah, please do.
In the planning I've seen, the most difficult questions tend to relate to how to deal with the inactive spouse and inactive children. And often there's a drive to get disposal rollover, and therefore you go, okay, we're going to give the spouse the shares irrespective of them being active or not. But you could look at an estate freeze and pref shares of one way of managing that, as well as testamentary trusts. And then the same with inactive children. There seems to be hesitancy to differentiate between active and inactive children, and that's understandable but problematic.
It's understandable but problematic, exactly. And that's one of the big questions, especially in smaller or medium-sized family business, where really I think it's important to keep ownership and management of the company in the same hands, if at all possible. You see the big families, multi-generational families that will find a way to involve non-active family members throughout the generations. It's again not a one size fits all solution, but in a small or medium sized business, I like to see the active children be shareholders and the inactive children be looked after in some other way. And maybe it's insurance, maybe it's other assets. Maybe the family wants to set up a foundation and have these other children manage the foundation. There's any number of potential solutions.
Yep.
Powers of attorney, I always say to people, if you're having your wills done, have powers of attorney done at the same time. And if you're a business owner, you can appoint someone as your attorney. Obviously, that person has the ability to exercise the shareholders' ownership rights, such as voting shares, electing directors. Someone acting under a power of attorney cannot step into your shoes as a director. They cannot exercise your discretion as a director, but they can vote your shares. And again, it's an important role to assign. There's limited protection for negligence or liability. It's basically covered by legislation. If powers of people acting under a power of attorney have fiduciary duties, and they are bound to manage the individual's assets for the benefit of the individual, not for their own benefit. And obviously, sometimes that doesn't happen, unfortunately. But the choice of attorney can be quite important for a business owner because of those ownership rights that they essentially can be delegated. Trusts, a big part of planning for family business. We see family trusts often owning shares under an estate freeze. We've already illustrated that with our John and Kim example. Alter ego and joint partner trusts, we don't have the time to talk about those in depth, but for people over the age of 65, you can use these trusts to hold assets and avoid probate, avoid probate fees, but also avoid the public disclosure of what you've done. A probated will is a public document. Alter ego and joint partner trusts are private. Spousal trusts, we've already addressed. I see a lot of testamentary spousal trusts in situations where there's a business owner who wants to get tax deferral, but not necessarily leave full ownership to the surviving spouse. There are some concerns, I guess, around having insurance owned in a life interest trust, concerns expressed by the CRA. We don't think that they are perhaps correct in their interpretation of how this would work. But if you've got a spousal trust, there are many ways to plan around this particular problem, but just be aware owning insurance in a life interest trust is sometimes problematic in terms of getting the rollovers that we're expecting. There are stop loss rules I'll ask Kevin to address briefly in these two sections, 43.6 and 3.61. Typically, we don't run into this, Kevin, but we need to be aware of them, correct?
Correct. Yeah, it's a rule that's designed to prevent taxpayers from transferring property with losses to their corporation in order to trigger the loss to offset gain. So basically, the rule says that if you transfer property to an affiliated corporation, which is typically one that you control, the loss will be denied and will be added back to the value of your share. So it's not a total loss of the loss, but it's a deferral of the loss. And that rule could potentially apply where an estate has shares redeemed by the corporation and creates a capital loss that they want to carry back. But there's a particular rule in 43.61 that says that 43.6 does not apply where a loss is being carried back under 164(6), which is the loss carryback rule that we rely upon. So you typically don't have to worry about it in an estate situation where you're using a loss carryback to offset gains in the terminal return. And also they're often not affiliated after the redemption takes place. But for example, if an alter ego joint partner trust is being used as part of the structure and and there's a loss that's created, this rule could impact that. So it's not something you need to be overly anxious about, but it's there on the periphery and could affect certain types of planning.
Thank you, Kevin. And so we'll move on now to talk about family business agreements, family shareholders agreements. And as we've said, it's not always understood or acted upon in a family, the need to fully plan and document business arrangements. There's sometimes a lack of formality that creates issues that aren't otherwise there in arm's length agreements that are generally widely accepted and understood. And this runs a little bit contrary, I guess, Kevin, to one of the initial statements we made in the first webinar, which is that study that indicated that there was, I think, over 80% of businesses with a second generation had an agreement. I personally don't believe that, but in any case, you're going to sit down with your clients and you're going to find out if they have agreements, and hopefully they do. Some of the key factors, the big one, parents control now, but what happens when they're gone? In many cases, while the mom or dad or both are still alive, you don't really need an agreement for the day-to-day, because the parents, through parental control more than legal control, determine what happens. But as soon as they're gone, that's the problem. That's when it comes up in a lot of families anyway. We certainly see problems. It doesn't necessarily require the parents to be gone for problems to arise. We could list some names we'd all have heard of, but in general, once the parents are gone, then for sure we get into the family dynamics and how that all unfolds. And another key factor we'd all agree, I think, is the abilities and interest and maturity of the second and subsequent generations. Are they in a position, are they able to step into their parents' shoes and continue running the business efficiently? At a minimum, there should always be an agreement where more than one family member is a shareholder. And I guess I would say where more than one generation is represented as a shareholder. There should always be an agreement. Maybe there's an exception where shares are owned only by two spouses. I've seen one case. There are probably many more, but I've seen one case where mom and dad owned the shares and they had a shareholders agreement, which you would think isn't necessary, but in their case, it made sense because it was a unanimous shareholders agreement. They wanted to make sure that if and when their children became shareholders, they were automatically by law bound by that agreement that dealt with things like death and disability. So they had thought it through. And that's one reason why maybe a company that just has mom and dad as shareholders still should have an agreement. But certainly when there's more than one generation represented, there should be an agreement. It's ideally executed at a time when emotions are not running high and during the founder's lifetime. You could even have a trust owning shares, let's say for children that have reached the age of majority. It's not unusual to have a trust for older children. Those children can sign a shareholders agreement, even if they're only beneficial owners through a trust. They can sign an agreement under which they have rights and obligations if they actually become direct shareholders, if shares are transferred from the trust to them. Independent legal advice is a must, and that's another thing that's easy to overlook in a family. The family lawyer prepares all the documents, and typically the family lawyer will be acting for the parents, and ILA, independent legal advice for everybody, is the best way to make sure that the arrangements are enforceable. What are some of the issues for family agreements that are perhaps unique? Well, larger family businesses will have family councils and boards. There'll be governance issues that are unique to the family. Employment and remuneration policies. Maybe the agreement should say family members will get paid the same way that arm's length people and with similar age and experience would get paid for as far as their employment responsibilities go. That's a good way to make sure that arm's length and non-arm's length employees at senior levels in particular are getting paid fairly and in the same way. Distribution of profits. Maybe mom and dad have preferred shares. They've done an estate freeze. and there are dividends to be paid, and maybe the shareholders agreement should govern that, so that there's no question that the owners of preferred shares are entitled to dividends in accordance with the agreement. It will deal with share transfers and triggering events, really like any shareholder agreement will. And it will deal with valuation, and we're going to address that in a bit more detail later, because that's a critical part of family business planning. The right to have shares repurchased, again, that could be unique to the parents who own preferred shares. You'll often see things called permitted transfers in a family business, where individual shareholders are entitled to transfer shares to holding companies that they control, to a trust, or to other family members. That is sometimes unique to family businesses. Shotgun arrangements, I don't necessarily like to see it in a family business. A shotgun arrangement is maybe the best way to resolve disputes, but it can really create a lot of personal issues, and it's not something I endorse even for arm's length parties. It can be a very nasty process going through a shotgun buy sell, and it's to be dealt with carefully. You might have additional restrictions on the transfer of voting shares. So maybe you've got active shareholders with voting shares and non-active family with non-voting shares, and there may be reasons to restrict the ability to transfer voting shares to other parties. That makes sense to me. Do you have tag along and drag along provisions? So if one of the shareholders has an offer from a third party, can they require the other siblings, let's say, to sell their shares, or do the other siblings have an option to sell their shares? Again, that's important in any, or can be important in any shareholders agreement, but you can certainly use that those vehicles in a family agreement. What are some potential triggering events? We'll deal with each of these with the idea of family in the background: death, disability, bankruptcy, matrimonial dispute, termination of employment. Let's look at each of those quickly. So death of a parent, sometimes you see a buyout, sometimes you see an insured buyout on the death of the parents, because they want to have a buyout, again, funded, so that there's money in the estate that perhaps can be used for payments to the non-active children, for the payments of income tax or charitable bequests. So on the death of a parent, you may see a simple gifting of shares under the will, or you may see an insured buyout, depending upon what works best for the family. Death of G2 or G3, children or grandchildren. Normally what we'd recommend here, we're dealing with younger people, typically a mandatory buy-sell funded with insurance, structured in the same way as you might do with arm's length shareholders. Usually you want to restrict the purchases to shareholders of the same age group. So the parents aren't going to buy shares from their kids, not likely. The purchaser would likely be other children, other G2 or G3 shareholders, or maybe the corporation would redeem the shares. That's normally what we'd suggest, much like you would have in an arm's length scenario. Disability, I would not recommend disability buyout for the older parents. That doesn't make a lot of sense, I don't think. Normally we're looking at G2 and G3 active shareholders, not inactive. I don't think you need a disability buyout for inactive family members, but for active, you might want to have an optional purchase by the other G2 or G3 shareholders. They can decide whether or not they want to buy, whether they can finance it. Maybe disability buyout insurance is there to help finance the purchase. But for sure, I'd be looking at disability buyout for the younger generations.
And it'll probably be cheaper to get too.
It would be cheaper to get if you're dealing with 30-somethings, not 60-somethings, exactly. Yep. Bankruptcy or insolvency, probably the same issues here as you would see in an arm's length case. If somebody suffers a bankruptcy, I would think you could have an optional purchase by the other shareholders. You would want to buy out that person in many cases, and maybe at a discounted purchase price if you really wanted to play hardball. Because you're buying from a trustee in bankruptcy, you don't necessarily want to give them full fair market value. Matrimonial dispute, well, that can happen. And sometimes we see in a family business some requirement that shares be sold if they are transferred to spouse under a matrimonial dispute. Typically, the best way to deal with this, although it's not easy, it's easier said than done, is to have a domestic contract so that an individual cannot obtain shares from a spouse who's a business owner, and other protection is provided to that person that keeps the shares from being transferred. If it's a unanimous shareholders agreement, the spouse obtaining the shares would be subject to that agreement. And I would think a buyout would be in order in that case. But again, you'd rather not go down that path. If you can have a domestic contract that protects the shares in the first place, that's usually the way to go. But again, that's easier said than done. Termination of employment. Should the termination of employment of an active family member be a triggering event? Maybe not if it's simply a retirement. You want to distinguish, I guess, between termination of employment and retirement. But if somebody's really acting badly and gets kicked out, terminated for cause, then maybe that's a triggering event for a buy-sell. And that's something that should be considered for sure. Valuation, really important in a family business. And I think we've talked about this at different times in the last, this session and previously. Where shareholders don't deal at arm's length, there's an archived IT bulletin where the department, the CRA takes the view that if the deceased and the surviving parties did not deal at arm's length, it's a question of fact whether the fair market value will be determined with reference to the buy-sell. So what that essentially means is if a parent is having their shares redeemed by the corporation, selling shares to a child, if one sibling is selling shares to another sibling, the CRA can interfere and say, for example, the purchase price is too low, it's below fair market value, and they'll deem it to have taken place at fair market value, which can lead to onerous tax consequences, let's say. And that IC bulletin and information circular that you see referred to there goes into quite a bit of detail on valuation and how the CRA views it. So parents and siblings are deemed not to be at arm's length, regardless of how strained the relationships may be. So what are some assumptions that should be made? And this, again, should be embodied in an agreement of some kind. Is there a minority discount? It's very common to see, let's say, G2 or G3 shareholders that hold a minority interest. Will that interest be valued less than fair market value because it's a minority? Probably not in a family setting, but who knows? Should there be a discount for tax payable inherent capital gains liability in the shares? I guess that's true of any business. Should the value of life insurance be excluded for buyout purposes? Absolutely yes. You do not want any risk of the amount of insurance proceeds somehow being added to the value of shares of a deceased shareholder. For sure, we recommend independent valuators be used. It's important to get an independent valuation thoroughly documented at different times in a family business setting to ensure that the CRA doesn't have any ammunition for overturning the values that you've determined. Price adjustment clause you'll often see in a family business where if something is sold and there's a subsequent successful reassessment by CRA, a price adjustment clause can come in to adjust the purchase price, and that at least helps avoid some of the onerous tax consequences. Dispute resolution, really important in a family business. As I said, a shotgun buy-sell is the ultimate way of resolving disputes, but it's really not maybe the best way to deal with it in a family business setting. Maybe you have arbitration or some such way of settling disputes by an independent party, disputes, whether it's about valuation or anything else. Consider a reduced purchase price for buy-sell arising on events such as bankruptcy or breach of the agreement. Already addressed bankruptcy, and that is something to consider. You're in effect punishing someone for not managing their finances or for breaching the agreement. And with that, before I hand it back to Kevin, and I'm going to hand the poll question over to Christine and Kevin because I cannot see the poll questions for whatever technical reason. So I will stop there and pass it over to you two.
Sounds good. I will launch the poll number 2. There were some comments actually earlier that people couldn't see it, so I'll just read it quickly.
Sure, go ahead.
First one, yeah, perfect. First one is family businesses are more likely than arm's length shareholders to have a buy-sell agreement in place. True or false? Number 2 is a buy-sell agreement with a valuation formula will always determine the value of the deceased shares for purposes of the deemed disposition rules on death. True or false? And number 3 is under the pipeline strategy, the CRA has indicated that the amalgamated company should not be wound up during the first year of the estate of the deceased shareholder. True or false?
And we haven't gotten to that point yet, so that will be interesting to see how people respond.
All right, good one. That's your question, you too.
It is.
Come on. Just a good guess then for number 3. We won't hold it against anybody if they don't get it right. 70% advanced.
Still climbing.
Yeah.
I think it's slowed down.
It's almost at. Yeah, I think so too. Okay.
Okay, so the response to question 1 is false, and 91% of that got 91% got that. That's terrific. The response to number 2 is also false. That was much closer. So the question is, buy-sell agreement with valuation formula will always determine the value of shares. In the majority, if you're dealing with arm's length shareholders, that is likely very true. If you're dealing with family-owned businesses, less likely to be true. So that's the reason why it's false. And under the pipeline strategy, CRA has indicated companies should not be wound up in the first year. And despite not having covered that point, 72% of the people got that answer right.
Well, maybe we don't have to do that section now then.
Well, we might go quickly because we are
Yeah, we are kind of short of time anyway.
So that's great. Thank you. And we'll start moving along. So the next area we want to talk about is estate freezing, and we've already mentioned it a couple times, so I won't spend a lot of time on this, but it's a simple it's simple to, I guess, explain, more difficult to implement. But the idea is you've got an older shareholder that has significant shareholdings. The shares are worth a lot of, have appreciated dramatically, and therefore there's going to be potentially large gains on death. And the value of doing a freeze is to freeze the value of the shares, which also helps with determining the funding requirements on death, that, and in particular, how much insurance might be required. And it passes on future growth to the next generation. And in doing so, you may get to multiply the capital gains exemption, which is about $900,000 per person. So there's a way to pass on future growth and utilize the exemption to offset some of that growth from a tax perspective. So the approach is the shareholder, in this case, Anika, exchanges the common shares for pref shares, their fixed redemption value. And on Anika's death, those preferred shares are deemed to be disposed of for their redemption value. And you've got typically children or family trust subscribing for common shares that represent the future growth of the business. So this is what the after effects of a freeze might be. And here, the structure may be different than you may have seen, because the beneficiary, you often impose a holding company in here. In this case, the holding company is a beneficiary of the trust. It's not the direct owner of shares. And Glenn, maybe you could talk to why this strategy makes sense.
Yeah, one of the things we like to do with this, or one of the recommendations, is to have a structure where you don't have a holding company that's a direct shareholder of OpCo. What we'd like to do, if the shares are sold to a third party someday, is have the beneficiaries, the individual beneficiaries of the trust, benefit from the capital gains exemption. If there's a holdco in between the trust and the operating company, and maybe the holdco has investment assets in it, it's passive, it's much more difficult to get the capital gains exemption. In this case, if you structure it this way, OpCo is going to remain pure. It'll have no excess passive assets. If there are any that develop in the retained earnings, they can be paid up to the trust and then on to the beneficiary company as a tax-free intercorporate dividend. So you're taking that passive holding company and taking it out of the chain that's going to be sold to the third party down the road. So this is why we'd like to see this sort of structure.
And the other benefit of this structure is you can hold the insurance in the beneficiary co. You can use OpCo's income to indirectly fund the premium, flowing it through the trust. And the insurance policy, you can either have beneficiary co as the beneficiary of the policy, or if it's there for buy-sell or other corporate purposes, you could have OpCo as the irrevocable beneficiary of that policy with a release of it at a later date if needed. So
Right.
that creates
totally.
a lot of flexibility.
Exactly. And then the beneficiary co can be held by whatever family members are involved. It doesn't have to be individuals that are active in the business. It can be owned by the adult children and the parents, for example. So the beneficiary co is totally out of the business side of it.
Yeah. And so there's a number of benefits that we'll just quickly go through: probate fee planning, family law planning, intergenerational planning, creditor proofing. All of those good things can be accomplished through that kind of a structure. Another area that's very important within a family-owned business, but it also applies in arm's length situations where children may be involved, is a balancing of estate values. And typically the situation becomes of concern where you have children that are active and you've got children that are not active, and you're trying to treat everyone fairly, not necessarily equally, but fairly. And here you can manage that through lifetime gifts to the non-active children, bequests under the will, having insurance that is designed to go to the non-active children, and also looking at possibly creating special class of shares to have corporate-owned insurance that will flow through to those shares which are owned by the non-active children. Another area that is discussed in the guide, and I don't think we'll spend a lot of time on it today because of timing, but it's the overall purpose of pipeline planning is to effectively ensure that there's only one level of taxation, because there's potentially 2 or 3 levels of taxation when someone dies owning shares in a private corporation. And you want to preserve the capital gains tax rate because it's lower than dividends. And it's not restricted to family. This pipeline strategy is not restricted to family businesses, but may be more applicable where you're trying to preserve the business for succeeding generations, and it's subject to a number of CRA guidelines and interpretations. There's an example here that I'm not going to spend much time on, but essentially what happens is on the death of the owner, the capital gains is realized in the estate, and we try to preserve that taxation just as capital gains by doing a corporate restructuring and bumping up you can bump up the value of certain assets in the companies as part of that structure, and ultimately you can pull out the money from that amalgamated company through a promissory note without any further taxation. And as you've already answered the question too, CRA rulings has indicated that this planning is acceptable as long as the distribution of assets from the amalgamated company takes place over time, and at least not within the first year of the estate. Because of that, life insurance can play a number of roles, and one specific role is covering the tax liability that arises on the death of the owner. So here you do a pipeline structure, but the values are locked up in the company for at least a year, whereas Jacob has triggered a large gain in the terminal return. So corporate-owned insurance on Jacob's life could be used as a way of both funding the pay down of the promissory note, but creating liquidity in the estate to cover the tax liabilities on death. Section 84.1, a lot has been written about this. There were changes made last year to it as a result of a private member bill. Essentially, these rules create a tax penalty for transferring corporate private shares to family members, particularly where the family member is using a corporate vehicle to own the shares, and it converts the capital gain and the potential use of the capital gains exemption. It eliminates the use of the capital gains exemption by converting that gain into a deemed dividend. The Bill C-208 has created an exception to that rule where shares of a small business corporation are transferred to the owner's children and grandchildren, but the rules were not drafted by finance. They don't like the rules the way they were drafted, and they indicated that they would be introducing amendments which are still outstanding. So we can't give you much more direction as to where finance is going, but there is discussion in the guide. And of course, once the new rules come out, there will be lots of commentary, and you'll get appreciation for what it means. But right now, you can use these rules to transfer shares to a corporation owned by children or grandchildren and not be penalized under 84.1. So what are some of the overall conclusions we can draw after all this discussion? And we've already said a number of these things. Is the best way often depends on a number of variables that can only be determined at the time of death. So therefore, flexibility in the design is very important. When you're dealing with a family-owned business, there are different dynamics that come into play that need to be recognized and managed through the process. You may deal with partnerships, and you need to have an appreciation of the partnership rules. And overall, you're part of a team, or you should be part of a team of professional advisors working in concert to manage the various elements of the implementation of the buyout and the overall estate plan for those individuals. So that concludes our comments, and I'll turn it back to Greg for questions.
That's great. Thanks, Kevin. Thanks, Glenn. Lots of food for thought, lots of detail. I'm sure some folks are exhausted anyways, at least I am. But, and you know, if you have a Q&A, you know, put it in the Q&A section if you want. I can't say we're going to get to it because we don't have a lot of time at this point. But let's get to a few of these questions. So anonymously, we were asked, what is the best structure for a partnership?
Well, that's a general question.
We're going to give it an anonymous response.
Yeah, yeah. I mean, as Kevin said, well, first of all, it depends on the structure. Do you have corporate partners or not? As the first question. And I would say if you have corporate partners, then something similar to the holdco-opco structure we described is often the way to go, with the holdco owning a share, owning an insurance policy on the life of its shareholder individual, with the partnership as beneficiary. That's often an effective structure where the partners are holdcos. Where there are no holdcos, we would typically see the partnership itself as the owner and beneficiary of the insurance. I don't know if Kevin, if that's a very general answer, but if you have anything to add.
Yeah, well,
of course, the guide does cover a lot.
Yeah, there is an issue where you have individual partners. The rules do not allow the flow out of that insurance to the deceased on a non-taxable basis. It has to be flowed out to the surviving partners to facilitate the buyout. So you can't have an arrangement where you've got a partnership arrangement that says on the death of Joe, we're going to buy, the partnership's going to buy his interest. That does not give the right tax results.
Well, and Joe's no longer a partner. That's the reason, right?
That's right, because
not
Joe's no
partner,
longer
so-
a partner.
yeah, exactly. So, yeah, so those are, that's a very good point. And so there's no way of answering that question any more specifically. I don't think. It will depend on the partnership structure.
All right. Clearly a broad question for sure.
Yeah.
So Lauren Zalaski asks, what happens when shareholders are Canadian resident citizens, own vacation property in the US? What is the effect on the estate when bringing their Canadian shares into a CCPC?
I would say no effect on the buy-sell if they're Canadian resident citizens. There is the potential for US estate tax on the property in the US. And there is an exemption available that's prorated based on the value of assets owned by the Canadians. So the larger that piece of property is of their total estate, the lower the exemption. But I don't think it has any specific effect on the buy-sell arrangement.
No, and it might also have obviously Canadian tax implications. Is it the principal residence or not? And if it's not the principal residence, then there's capital gains tax in Canada
Okay,
if it's gone up
That's-
in value.
right. Okay, very good. Jonathan Corrigan, can you give us more information on structures that help avoid loss of the capital gains exemption?
Over to you,
Um,
Glenn.
Well, yeah, I guess maybe the one structure is the one we addressed with the estate freeze example, where you've got an estate freeze, a family trust owns common shares, there's a beneficiary company that is not a direct shareholder of OpCo. That's a really good way to purify OpCo, because any surplus funds can be paid up through the trust tax-free to the beneficiary co as an intercorporate dividend. So that's one way to do it. Another way is to make sure in all cases, if you've got a holding company, maybe you retain some direct share ownership personally in OpCo, so that even if Holdco has a bunch of passive assets in it, you've got as an individual direct ownership of an operating company, and it's those shares that would be eligible for the exemption on a sale. That's a couple of examples.
Yeah. That's the one I've seen, Glenn, where you may have the Holdco enter between the operating company and the family trust, and there may have been a freeze, and there's sufficient shares retained personally by the parents to utilize whatever remaining exemption they have upon their death.
Right. And in that structure, again, the holding company could have a lot of passive assets in it, could own insurance, investments, whatever else.
Yeah.
Agreed.
All right, terrific, thank you. Judith Mewart asks, will there be alternative minimum tax to be paid under any of the tax-free scenarios?
I guess there's potential AMT on a tax exempt capital gain, but I don't believe it applies in the year of death, if I'm not mistaken. Or I'm going back and dredging up things from my memory now. The thing about AMT is it's recoverable. So if it's payable in a given year, it's likely going to be recoverable in subsequent years. So that's kind of a half answer to that question. But I don't think it applies on death when you've got an exempt capital gain, as in our example with Kim. I don't think it's an issue. It can be an issue if you've got an exempt capital gain during lifetime. And as I say, it's AMT is recoverable over subsequent years anyway, and typically gets refunded.
Yeah, but it's a good question that I've not thought through fully, but I don't think there is AMT on the capital dividend. So we're just really worrying, I guess, I think about the capital gains exemption.
I think so.
Okay.
Good question.
All right, let's try to work in one more. Apologies to the rest. We won't get to those. So what happens if there is a decrease in the value of the business so that there is more insurance paid into the OpCo than is needed for the share purchase? I think you addressed this last week, Glenn. Thought you did anyways.
Again, a good question. And there's a number of different answers to that. You can intentionally, I guess, over-insure. And if the agreement says we're going to buy out at fair market value and any excess insurance is essentially retained by OpCo as a key person benefit, that's one approach. Another approach is to say that the purchase price will be the greater of the amount of insurance and the fair market value. I like that in economic uncertainty, because what if somebody dies while there's a temporary downturn and they happen to die when the value of the business is depressed? Maybe if they had to sell at fair market value, their estate, their family's obviously suffering in a circumstance where share values might recover in the next year or two. So a shareholder is protected from that sort of scenario if the agreement allows the purchase price to equal the amount of the insurance if it's greater than fair market value. There's no right answer. Those are a couple of thoughts, Kevin. I don't know if you have any.
Yeah, I think it's a good question, and it raises issues where you're both over-insured and under-insured, and the main thing is the parties should contemplate that and have it specified in the agreement, so there's not a battle on the death of a shareholder.
Yeah, whatever the intention, that question should, and that's a really good question, and it's one that should be asked when the agreement is being drafted and covered off the way Kevin just described exactly.
Well, gentlemen, I guess we've come to the end of our time. Certainly appreciate the presentation, the depth of presentation, the book, of course, the guide. It's going to be a wonderful asset for everyone. I want to thank Kevin and Glenn for all the work they've done. There's still some outstanding good questions there. So if your question wasn't answered, just reach out to ce@advocis.ca, and Kevin and or Glenn will undertake to respond to that. Now, as you know, your registration for this event includes a complimentary copy of the guide. These will be mailed out to the address that you specified when you registered. If you would like to purchase additional copies at a discounted rate, please complete and submit the book order form. And also, if you're interested in adding to your insurance and estate planning reference materials, here are some additional books authored by Kevin and Glenn. And we have a technical glitch for a second, and Kevin will bring that up, folks. Let's just wait for them to come up.
There we go.
Thank you, Kevin. And I note that the slides are not available for distribution. I think there were some questions about that. However, a reminder, all the material is covered in the guide. We will also be making a recording of this webinar available on demand within the next week or so for your viewing or reviewing pleasure if you want. So watch for an email from us. And lastly, a short survey will appear at the end of today's webinar, which we hope you will take a quick moment to complete. Your feedback will be very helpful to Advocis in planning future webinar programs. So again, thanks everyone for participating in today's session, and enjoy the rest of your afternoon. Thanks, Kevin. Thanks, Glenn. Take care now.
Okay,
Bye-bye.
thanks,
Greg.
everybody.
Thanks, Christine.
Thank you, everyone. Bye-bye.
Take care.
Thank you both. Thanks everyone for attending. We'll see you soon.
Bye now.